Welcome to one of our positive transaction videos. I'm Tony Skursky, the broker here at Transaction Realty, and today with me I have Barbara Cripple from Affinity Home Equity Solutions. Welcome, Barbara.
Thank you for having me.
You know, one of the questions I always get is, what is a HECM loan for purchase? What actually can happen with a HECM loan for purchase?
A HECM for purchase is an FHA insured loan where any individual age 62 and over can purchase a home for a one-time down payment of about 50%. They will then move into that home and live in that home for the rest of their lives and make no monthly payments back to the bank.
So where are they getting that down payment from? Do they have to sell a house, or?
Oh no, they don't have to sell a house. That's what usually happens. We typically have buyers who are selling the old two-story colonial that they raised their family in, but that's not necessary. So sometimes it could come from savings accounts, it could come from retirement accounts. That down payment can come from anywhere. It's just got to be about 50%.
Okay. So what's the difference between a HECM for purchase and just a regular conventional 30-year mortgage?
Okay, with a 30-year loan, you're going to have a down payment usually smaller. I think typical it's about 20% maybe on a 30-year loan for a down payment. And then you're going to make monthly payments back to the bank. And over that 30 years, you're going to pay down the balance of your loan until it's eventually paid off. With the HECM for purchase, we have a larger down payment, usually about 50%, but then there are no monthly payments ongoing. So you're going to keep that money in your pocket every month by not making a mortgage payment. And then when you pass away or no longer live in the home, then the loan is paid back with interest.
And I think you already said who's eligible for this program.
Anyone who's 62 and over. Now, if you're a married couple, at least one of you has to be 62. But the other person can be younger as long as at least one borrower is 62. You do have to live in the home, okay, that is a requirement. Okay. So you can't use this to buy a rental property. I know your mind's probably spinning about how much money you can make on a rental, but you do have to live in the home.
Do you have to have a job?
You don't have to have a job. In fact,
That's
most
crazy.
Most of my borrowers do not have a job. They're usually retired. We've got Social Security income and things of that nature.
So they do have to have some type of income coming in to live on.
Sure, absolutely. You know, everyone has expenses and you've got to be able to meet your mandatory obligations.
Okay, but you don't have to have a job.
No, you don't have to have a job.
That's fantastic. That's fantastic. Well, Barbara, I'd like to give you a scenario of what my parents went through. My parents paid off their home early. They lived in a colonial in Parma, Ohio, and they had around $100,000 in equity in the home. We found it very difficult to be able to purchase them a home that accommodated their new needs. Would this type of loan help them?
It certainly would have. So in your parents' situation where you've got the two-story colonial and it really it's hindering their mobility and it's difficult for them to age in place there, it's not uncommon to want to move to a ranch-style home. I'm not sure what you were looking at or what they were looking at, but what we could do with your parents is basically double their buying power. So for the $100,000 that they would have got from the sale of their old home, we could have put them into a ranch-style home with a purchase price of about $200,000, and it wouldn't have changed their monthly financial situation at all, because they would have used the $100,000 for the down payment. They would have purchased the $200,000 home with a HECM for purchase. They would have lived in that home with no monthly payments.
Well, this sounds like a great option that they could have used. So a lot of times when I talk about a HECM loan to clients, the first question they ask is, well, what happens if my parents outlive the loan?
They shouldn't outlive the loan. This loan would be good until the youngest borrower is 150 years old. So if one of your parents lived to be 150, that could be a problem, but we haven't had anybody live that long yet. So if it gets to that point, we may reevaluate.
That would be a good problem.
But the chances of them outliving the loan, it wouldn't happen at this point.
What if one of the children want to actually keep the home for themselves? How does that work?
So if one of the children want to live in the property after their parents have passed away, they can do that. What they would do is they'd just go to the bank and get a loan for whatever the balance is of the HECM loan, and then they would have their own loan that they'd make payments back to the bank just like they were buying any other house.
So once one of the children decide that they want to keep the home and there's actually more due on the mortgage compared to what it's worth, how does that work?
Okay, so in the situation, let's say mom lived to be 125 years old and there's more owed on the house than what it's worth at that time. The children, assuming the child wanted to keep that home, they would be able to purchase the home for 95% of what it's worth at that time if mom owed more than the house was actually worth. So the child wanting to keep the home, they don't have to pay any more for it just because mom's loan was larger than what the house is worth. Worst case scenario, they'll buy it for 95% of what it's worth at the time mom passes away.
So when it's evaluated by an appraiser, they would be eligible to purchase that at 90% of that value.
95%, and yes.
95, very good. So when my parents were ready to move out of their colonial, they already were retired. And we went to the bank and tried to get a loan, and they were denied. So how does that work with a HECM loan?
Okay. With a regular conventional loan, they would have had a debt ratio requirement that they needed to meet. With a HECM loan, we don't have a debt ratio like the banks have a debt ratio. We do have a residual income requirement, but it is so much easier to qualify for. Number one, probably the biggest thing is there's no payment for us. So there's no payment that they have to qualify for. We just need to make sure that they have enough income to meet all of their mandatory obligations and still be able to eat 3 meals a day.
And what would their mandatory obligations would be? Taxes, insurance?
Taxes, insurance,
any homeowners
utilities.
associations that they'd have to
Absolutely.
join?
Correct, just like they would still have utilities and things of that nature. But yes, this does eliminate the mortgage payment in itself, which is a huge help for a lot of boomers.
Well, I'm a baby boomer myself, and I'm very close to that, so I see this as an opportunity.
I think you got a few years, Tony.
I'll keep that in there. Okay. So how long does a HECM loan take to get, and then also, what are the interest rates?
Okay. Processing on the HECM loan, it typically takes, we say 30 to 45 days. Now, the one thing you need to know is that there is an independent HUD counseling session that every borrower has to attend, and we really can't move forward with their loan until they have attended that. That usually takes about an hour, is typically done over the phone, but it's really for the buyer's protection to make sure they know all the ins and outs before they move forward. So typical processing is between 30 and 45 days. Whether they have a fixed or adjustable rate is up to them. We do have both. The fixed rate right now is running about 4.5%.
That's just like the regular market almost. That's great.
You know, it's actually a little higher, just a tad higher than what you could get a 30-year conventional loan for. But keep in mind, our loan is good until you're 150 years old. So for a 65-year-old, that could be an 85-year loan.
So this all sounds great. How does the bank make money on this type of loan?
Well, it's not interest free. So all of the interest is deferred for as long as the borrower lives in that home. So basically the bank is just waiting and delaying making their money until the borrowers no longer live in that home. So the fact that it's not interest free, believe me, the bank's still making money. All of the protections come from the FHA insurance. So the bank is still making their money. The FHA insurance is a pool of money that would pay for any overages. So in the situation where your mom lived to be 125 years old, you went to sell the house and there was more owed than you could sell it for, that difference actually comes from FHA. So that's how the bank stays whole, and the bank still does make money. They've got shareholders to answer to.
Well, it sounds fantastic. I wish I would have utilized it with my parents. Barbara, thanks for coming in today. I appreciate all the information on a HECM loan, and thanks for tuning in today, and have a super day.